Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And just to let you know, I've opened up registrations for pre-order of my new book called Wealth by Design. You can find out a little bit more about the book, the pre-order process and the bonus that an AI tool that I'm going to share at the end of today's episode. In fact, it will be there at the end of every episode from now on, although I might update it every now and again. Anyway, let's get into today's episode. First question is from Chris. Chris is 39, his wife's 35. They live in Osborne Park in WA. House is worth around $950 with $260,000 owing, so not a lot of home loan debt. They've got an investment property in Noamara, which is about 10 k's north of the Perth CBD, so pretty close to the centre. It's worth $650 with $375 owing and rents for $650 a week, which is a pretty strong yield, of course. And he's asked whether the properties are investment grade. And then he's talked about wanting to upgrade to, a better location, better property, so forth. And he thinks it needs to spend about $1.4 million. And he's referenced, to my idea of upgrading as soon as you possibly can, even if that means borrowing until you get indigestion, as I put it. So, really pushing your comfort levels. And he feels like they're in probably a good position to do that, as he earns 190 grand and his wife just got a promotion earning 105,000. So nearly 300,000 of family income there. And he's talking about borrowing 700 to 800,000 in order to do that. And he's just sort of asking, well, what do I think about that situation? So I've sort of paraphrased his email here and his questions. So I think the first thing is it's really difficult for me to look at property and go, yes, it is investment grade. No, it's not. I mean, firstly, it takes a bit of time and analysis to really dig into the detail, understand the property past performance of comparable properties in that location relative to, the broad capital city or city as a whole. And then the second element to it is really local area knowledge. So we would speak to some trusted advisors that, know the area very well and get their opinion on it as well. So I can't all do that in this podcast, but I did look up the address and I do see the home in Osborne Park is on a main road. And in fact, Chris, to his credit, acknowledges this. So we need to really think carefully about something like that. I'm not just going to pick one attribute and go, that attribute knocks this property out, but I can say that I wouldn't buy a property on a busy main road. It is without a doubt a very clear characteristic of underperformance. Now, there are exceptions to that rule. It could be that, for example, there's multi-use of a property on a busy main road, so in terms of a development site, because what you'll find is a lot of higher density tends to occur on a busy main road. That's just because land value tends to be more affordable in those locations. So that's why you can't apply just broad-based rules to things like property. No two properties are the same, and so you've got to look at it independently. I haven't looked at the investment property, but I think I've got enough information to at least guide Chris in the right direction, and anyone that's in a similar situation to Chris, of course. I mean, it's true. I mean, I like just to qualify the borrowed till you get indigestion sort of comment. Of course, I'm never suggesting anyone goes and borrows to a level that is stupid. I think what I'm really more suggesting is, okay, you've got to think about all the things that can go wrong. You've got to be prudent. You've got to be affordable and so forth. But we just got to recognize that an assessment of someone's borrowing capacity is heavily influenced by their own emotions. And I've mentioned this previously. I've sort of been influenced by that as well. And so, someone emotionally couldn't care less about borrowing, and another person could be, so paranoid or stressed out about borrowing too much. And, so those two people are going to have very different approaches. So when I say borrow to the point that gives you indigestion, I think it's really more putting aside your own sort of risk profile to some degree. Just focus on the actual numbers and the actual facts. And if you think you can go and buy a property, and the worst case scenarios, I've said this before, the worst case scenario is, and you can make friends with this worst case scenario, by the way, the worst case scenario is that in, say, 2 or 3 years' time, if it's all too much and it's all too stressful, you sell the property and walk away. And if you can do that and not crystallize a loss, so you can cover your entry and exit costs just by buying well, improving the property or buying the right time, these sorts of things, well, then nothing ventured, nothing gained, and at least you haven't lost any money. And that's kind of the approach that I have used myself personally, and I would recommend or suggest to people, because it means that, to sign up for a huge mortgage, you go, oh my God, how am I ever going to repay it? But it's really difficult to sit there and go, I've got a clear plan of repayment, because it's very difficult for people to kind of see out, where they'll be in 20 years, 10 years, these sorts of timelines. So it's really just about making a good long-term decision and then, trying to remove as much emotion as possible. Of course, that's not to say, just go in blind and have no plan to repay the debt. Anyway, let's come back to Chris's question. So the first thing you've got to do, Chris, in this situation, or anyone in Chris's situation, is work out, what will these properties contribute towards my financial future? Not necessarily over the next 1 or 2 years, but what sort of contribution will they make to me achieving my financial lifestyle goals, say in 10 or 20 years' time? I mean, Chris is 40, nearly 40. So let's say 20 years' time as a time horizon. And versus, what are they going to cost me? And of course, he's got quite a bit of equity in his home, about $700,000 of equity in his home. That's tax-free. So by hanging on to that property, you're going to take on an extra $700,000 in non-tax deductible debt. I can tell you the risk-free, the guaranteed cost of that is going to be 6%, circa 6% after tax. That's a substantial cost, right? So you've got to earn then, a pre-tax return north of 10% to be better off. Is that likely if your property is on a busy main road? The answer is probably no. So it's really, the focus would be really question whether that asset's going to get you where you need to be. It's probably a case of sell it. You sell it for $950, maybe go and borrow, 6 or 7, 800,000 if you're comfortable do that. That'll give you a budget of maybe 1.7-ish to get into a better suburb. And notwithstanding the lifestyle benefits that typically result in making a decision like that, and I'm speaking from personal and also professional experience, but most likely the growth that you'll get from that one asset will be better than splitting your eggs across 2 assets. So that's sort of the approach, I guess, we take in regards to, whether a property's investment grade or not, and how it sort of fits into a strategy. But thanks so much for your feedback, Chris. I saw your question and your nice feedback on the podcast, and I hope that's helpful to you, and all the best. Okay, next question is from Frank. In fact, I should have answered that one first, because unfortunately we missed the question. Frank emailed his question all the way back in July last year. So apologies, firstly, Frank, for that. Frank's asking whether I should include tax when calculating my net worth, which sounds like a basic question, but it's kind of interesting. And he also asked whether I should be including my primary place of residence in my net worth. So I believe that our job in my business, in terms of Pro Solution, the firm, our job is to help people maximize their net worth on an after-tax basis. And the reason I put it that way, and I'm just sharing this because I talk about it a lot internally, and the reason I say that is because ultimately we need a home to live in, great, and then we need to build wealth outside of the family home to fund retirement. And assuming that I would like to either spend or gift that money, and maybe I give it to my children or whatever, it could be a charity a little bit different because I can get a tax deduction for it, so I don't need to worry about the potential tax outcomes. But let's put that aside. Really, I'm building this wealth so that I can spend it or my family can spend it. And in order to do that, I've got to consider tax. And also by including tax, then it forces me to think clearly about the ownership structures that I have. So for example, and I've recorded a few episodes last year talking about trying to get as much money into super, because we can each have $2 million in super as it stands today, and that could be indexed in July, but $2 million, so if you've got a spouse, it's $4 million of your total net worth. And if it's all inside super, you're not paying any tax. Well, that's much better than, say, all in personal name and I've got to pay, full capital gains tax. And also, let's not forget, the Greens are pushing for a CGT review at the moment in terms of investigating whether the 50% CGT discount should exist. So, we should be tax aware because the level of indebtedness by governments around the world, there's going to be more and more pressure on tax revenue. So it's something that, if it's an issue now, it's going to be more of an issue in 10 or 20 years. So, Frank, probably the most accurate calculation of net worth is excluding your family home because, you arguably need that to live in. It's not an asset that you are using to fund retirement. And in fact, if you get to a stage where you need higher care, it's likely you'll sell the family home and use that as a refundable accommodation deposit is what it's called, really to get into a home and also to fund the costs associated with that care. So let's just say that equity that you've got in your home is either you're going to live there for the rest of your life or you're going to go into some sort of aged care situation. So we quarantine that asset. The rest then we're there to spend it. And so we should include the tax. And by doing that means that we're going to think clearly about and longer term about ownership structures. So it seemed like a basic question on the face of it, but it's a really good one, Frank. And thanks for answering, and sorry that we missed it back in July. Okay, next question is from Cindy, and there's really sort of two parts to Cindy's question. Should they do some renovations to their home and should they buy an investment property? So they're both 52. They'd like to retire at 62. So in 10 years' time, live in Brisbane in a big Queenslander, but it's always needing a bit of work. The property's worth about 1.8 with about 400 grand owing, and they would like to do some repairs, improvements that they think will cost around 250. Husband has $1 million in super and Cindy's is 400,000, and they're maximising concessional contributions each year and intend to do that. They both incomes around 180,000 gross. I don't know if that's together or each. With that super, I'm thinking it's with the husband super balance, I'm thinking it's each. So they've got 4 kids, 20, 18, 16 and 14. So 2 have finished school. Another one finished schools in 27. And so they'll get rid of private school fees. And the daughter finishes in 2029. And they've been focusing on maximising super, but they'd like to also do something for their kids. So they're thinking about buying investment property, but wondering if they've left it too late. Okay, there's a lot there. The thing with improvements and maintenance with property is that you can never avoid it. You only delay it. What I mean by that is that if you can only avoid it because you can't avoid it. You can only delay it. By that I mean that if you don't do the maintenance and keep it up to what buyers would expect in your area, and you go to sell that property, you're going to get a lower price. It's going to be less marketable. Fewer people will be interested in actually doing that work themselves, and you're reducing the pool of potential purchasers. So you're going to take a haircut on the sales price. That's why you can't avoid it. So you're going to have to do it at some point, arguably, in order to maximize the value of your property. So yes, there's a lifestyle element here. Yes, the home's not bought purely to fund retirement, but that's another financial consideration. Now, they might be doing renovations that, might be in good keep at the moment and they're just taking it to another level. That's a different kettle of fish, of course. But, if we're thinking about property, it's a false economy to think that, if I don't spend the money, that's what I've saved. Now, if we think about their situation, they've got 1.4 mil of super. Well, with contributions and, with a normal level of returns over the next decade, you should see that probably more than double. So that's 2.8, maybe $3 million in total super, probably more than $3 million. So super's going to do its thing, right? Just this is a back of the envelope calculation, by the way, and that's probably going to be enough to fund retirement. And that's probably going to be enough to get very close to a perpetual portfolio as well. So that's good. So then the question then becomes, with surplus cash flow and remembering that surplus cash flow is going to increase quite a bit over the next 10 years with kids finishing private schools, particularly there's another uplift in 27 when their son finishes school. So with that surplus cash flow, will they be able to repay the 400,000? Well, almost certainly. What happens if it's 650, another 250,000? So they go and borrow to do the renos. Will they be able to repay 650,000 over the next 10 years? They're probably going to to get very close to it? And then the final question then, would they be able to do that as well as carry an investment property? And I'm not aware of their sort of cash flow situation, but if their combined incomes 360,000, so 180 each, you would think that they're going to get pretty close to being able to do that. But that's the question. Is it too late? That is the question that we need to answer, because we want to make sure that we get rid of the home loan over the next 10 years. We'll easily be able to do that if we don't do the renos. If we do the renos, my guess is we're probably going to be able to still get there. And then the other question is, can I add an investment property? Do you need to add an investment property? Probably not. As long as your super is in good funds, good returns, low fees, or, towards the lower end in terms of fee range, it's not all about fees. It's about total returns after fees, of course. Then strategy is probably enough. You're probably in a strong enough position. But, then does that, at least if you go and buy an investment property, I wouldn't sell it in 10 years, by the way. If I'm going to buy an investment property, I would say to you, let's try and keep that property for as long as possible. So I wouldn't sell it in 10 years' time. But the reason you would buy the investment property is, yes, so that you have more wealth than you'll need. And that way you're in a financial position that if you want to help kids down the track, then you can afford to do that without compromising your own future retirement. So that would be the reason to buy the investment property. Whether you can do that is more a question of just sort of, I guess, projecting out what your surplus cash flow looks like over the next 10 years. And if adding an investment property is going to materially retard your ability to repay your home loan. So Cindy, I don't know what the answer is, but that's certainly the approach that I would take. And my gut feeling, with very little information, I might add, certainly not enough information to have a gut feeling on this, to be honest, but my gut feeling is you're probably going to be able to do it. Okay, next question is from Justin. I want to ask your views on Bitcoin. From past episodes, you seem somewhat skeptical, although please correct me if I'm mistaken. I understand your focus is on data-backed assets like shares and property, but Bitcoin now has 16-year track record. It's increasingly seen as an emerging asset class. Despite its volatility, even a small allocation, 1 to 2%, can enhance portfolio performance. And there's other stuff around what's going on in the US, stable coins, these sorts of things. Look, it's really difficult. I mean, it's difficult, it's difficult to say, look, I don't believe in Bitcoin, because anyone that invested 10 years ago would go, you're an idiot, Stuart. Look how much money I've made. And I acknowledge that, okay? Guess the thing is, you don't need to invest in every single asset. Like, you just need to invest in the assets that you feel most comfortable with in an evidence and rules-based way that are going to help you achieve your outcome. The reality is that there's always going to be something better, like in any market. Do you know what I mean? Like, if you look back in the last decade, in fact, if you look back in any decade in the past, there's almost certainly an asset or strategy that beat using index investing into shares or owning direct property. Almost certainly. It's just like there's always going to be someone that's richer, that earns more money than you, that's better looking than you, that looks younger than you. There's always going to be that sort of thing. But that's the thing with investing, right? It doesn't necessarily mean we need to invest in it just because, if all you're going to do is try and find the asset class that's going to perform the best over the next 10 years, that's a difficult strategy. And so my approach to investing is that there's got to be a logical, evidence-based, sound approach. And my concern with Bitcoin is the majority of people that own it and that hold it are doing so for speculation. There is no productive value of this asset separate from the technology being blockchain, because when we have AI agents working for us, I can see how blockchain's going to, work in that sort of environment. I think the technology is good, but let's just talk about Bitcoin. And the whole thing around Bitcoin, right, is that there's only a certain amount of Bitcoins in the world, and Hitoshi, or whatever his name is, that started it, and no one really knows how it started. Like, it's just this folklore kind of situation, and so that's the reason I'm buying it, because no one else can make more Bitcoins. That's great, but no one's using it. Like, no one's using it as a way. And even if it is successful, then it's going to be regulated, because governments have to regulate their own currency, because that underpins the whole economy. That's how you can manage an economy as a government, is by having a stable currency. And so to achieve stability, you need regulation. So if everyone starts using cryptocurrency, then it starts starts to become regulated, in which case the whole decentralized finance thing becomes an issue. Now, every time I write about Bitcoin or talk about Bitcoin, I receive a whole bunch of emails that, Stuart, you have no idea and you haven't thought about this, you haven't thought about that. That's okay. Okay. So I don't want the emails. I'm just explaining that I don't feel like I need to invest in Bitcoin. I acknowledge that whether it's Bitcoin today or something else tomorrow, there will always be something, a shiny object. Now, having said all that, anyone that is typically 40 in their 40s or below or younger tends to own some sort of cryptocurrency. So if you want to go and put 1 or 2% of your net wealth into crypto, I wish you the best. I think whatever. It's not going to move the dial in either direction. That's fine. So I'm not saying nothing, but for me, I like to eat my own cooking. And so I don't own any direct shares. I don't own any Bitcoin. And for the point of integrity in terms of doing what I say, that's my approach. And my approach doesn't have to resonate with everyone. But, Justin, thanks for the question. We have a few people in our firm that are one accountant, Manny, if you listen to this, you already know I'm talking about you, is very pro crypto. And, well, I like to debate it with him. Time will tell, but that's the reason. I want an asset to have a productive purpose, right? Direct residential property, you live in it, you can rent it, it's productive. I buy an index that's made up of stocks that produce profit and cash flow. There's productivity there. I'm not going to buy an asset if the majority of people that own that asset or asset class are speculators, because there's no productive value there. So that's just my viewpoint. I get that it's not going to resonate with everyone. Okay, next question is from Chris. Chris says, I've got a unique situation. I'd love to get your insight from someone that's impartial to my financial position. I'm 32 with a tech salary of $250,000 with commission and household income of $365,000. Home is worth 1.2 with about 915,000 of debt. So a little bit of equity to work with. The home's isn't in the best demographic or socioeconomic area and would like to relocate. The cost to do that would cost about $2 million to go and buy in that area. And Chris is worried because it would eat up, the repayments would eat up all of his salary, and they would need to live off his wife's salary, which is, more challenging. It feels like they don't have as much equity in property as they're located in Sydney, as most people in Sydney would have, and they're wondering what I think about that situation. They have no investment property, a small amount of shares, and a relatively small amount of super, about 140,000 or thereabouts. And they're also worried that if they don't buy in the next 5 years, they'll be sort of priced out of that area because their incomes aren't going to grow at the same rate as the property, well, as their borrowing capacity, really, or the capacity to be able to buy more correctly. Chris, I've spoken about this a number of times, and I answered the first question, which was also from a Chris. So Chris is today. So I won't go over old ground in that regard. I think what you got to do is you've just got to have a bit of a buffer in place. So the question will be, can you accumulate some savings as a bit of a buffer in case of change of circumstances? I don't know about your sort of family or family planning situation, but you need to think about that if you've got kids or you plan to have kids, how that kind of fits into the strategy if you're going to get yourself into a position where you have a high level of debt. You also need to think about how your income will change in the future, those sorts of things. And then the final thing, as I said in that initial answer to Chris at the beginning of today's episode, is approach it with a 2 or 3 year time horizon and say, well, we're going to give it a go, and if it doesn't work out, no big deal. And if you're not selling a great property in a great location, then the downside is pretty limited, I think. There's a lot of people, if you interview people, speak to people in, say, in their 50s today, a lot of them will probably tell you we couldn't afford to buy in this area now. If we didn't move when we moved in, it'd be unaffordable. And, I think that's true for a lot of people. There's a lot of, I've said it before, like I've bought properties, when I was in, how old's, he's 32. Yeah. When I was 32, I bought a property, I would have been around 32, bought a property just after the GFC or right in the middle of the GFC. And, I thought it was a big number in terms of a loan. I wasn't totally sure how it was going to work out. I wasn't oozing with confidence. It was one of the acquisitions that gave me indigestion, for instance. But you look back now and you go, well, that was easily affordable. You always make it work. I'm not trying to advocate for people borrowing just willy-nilly and going crazy, but you've got a really strong family income there. If you're confident that will continue, there's no guarantees. There's nothing guaranteed in life, of course. But if you're confident that will continue, Chris, then to my mind, try and make that move into that $2 million price bracket as soon as you possibly can. And probability is you'll look back in 20 years' time at that decision, whether you're still in that property or not, and go, look, that was a good decision. If we hadn't made it, we'll be locked out. And that's the key concern. So it's really about borrowing capacity, thinking about all the things that can go wrong. And as I said, if you can get in and out, and your worst case scenario is you cover your costs. So, you're better off, but worse off. That's not a bad outcome. All the best, Chris. Okay, next question is from Sienna and Lockie. I've been listening to your podcast for a while now and find it incredibly insightful. I listened to around 8 investing finance property podcasts, and yours is by far my favourite. I thought I'd read that out because it's such a nice and kind comment. So I appreciate your feedback. And this is from Sienna and Lockie. Thank you so much for continuously putting fabulous content together. You're so generous with your time and knowledge, and your community of loyal listeners couldn't be more grateful. So again, thank you so much for that feedback. Okay, so Sienna's 35, Lockie is 40. They've got an 18-month-year-old baby. Lockie's self-employed, earning about 150 grand a year. Sienna's income's predominantly commission-based, to 250 to 300,000 a year. So total household income's 4 to 500,000. Super balance is about 400 grand combined. Started an ETF portfolio 5 years ago that's just under 200,000, and they've been contributing about $20,000 a year. They've got 650 of cash in offset account and can save about $80,000 to $100,000 a year. They currently own 4 properties. One's a home. They've got a future principal place of residence they'll move into in 2 to 3 years' time in Parkdale. I think Parkdale's a great location in Melbourne, by the way. A house in Frankston and townhouse in Bayswater, which used to be Sienna's primary place of residence. Their plan is to move into Parkdale, sell Bayswater because it's underperforming, and do some renos and so forth. Also, they'd like to then buy a property for Sienna's mum in Parkdale that's close by and spend about $1 million on that. And they're asking questions. Well, Sienna and Lockie's questions mainly revolve, there's 2 questions. The first one is around that purchase. They want to buy that property without impacting their mum's Centrelink benefits, and so obviously age pension, those sorts of things, and wondering sort of how to structure that. At this stage, the mum's contribution is about 300 to 350, but mum also has an investment property, and once that's sold, she'll net 3 to 400,000. So let's say that's total asset base then in terms of the ownership of the home and the investment property of 600 to 750. So she puts the money into the home and owns a portion of that. Then the amount of assets she can have is 321,000. And so what you would actually try and do, the first question is, this is a Centrelink situation, and the best thing that you can do is probably get some advice from a Centrelink expert. That's not me. Could be someone else in my business, by the way, but I'm not strong on this. But I think the answer is work out how much money mum's going to be left over after she sells her investment property, and then she should own that proportion of the new property. And so what you'd want her to do is come at least close to or under the asset threshold for the full pension. And so for a homeowner, that's $321,500 to be exact, although those thresholds get indexed every year, I believe. So based on what you've told me, she might have a little bit too much money, in which case maybe then she should put in, say, closer to 400,000 towards the property, so own 40%. And that means that her 40% share as a homeowner will mean she'll be counted as a homeowner, I should say, and the other assets outside will be under the benchmark and the cap, I should say, and she'll get a full age pension. But I'm not an expert, so that's how I would approach it, but I'm not an expert. So you need to get some advice around that and how you structure that. If you've got siblings as well, you want to make sure that her will's up to date and these sorts of things, so that any sort of situation that you've got needs to be taken into account. In that situation, if you own the remaining portion of the property, your mum would need to pay a market level rent to you in order to get the tax deductibility and so forth for you to get the negative gearing, I should say. So you just might want to think that through and how you sort of structure that. I probably don't have enough information at this stage to give you some advice, but I will say, well, I've had a lot of different scenarios like this for clients, and I can't really, there's some situation, I mean, you can give your mum money each year. She can't give you money, or there's a cap on gifting if you within Centrelink. So it's possible that you make a gift to her, and then separately, it's possible that she pays you rent. So I don't want to be too contrived here, but hopefully I'm sort of hinting in the right direction, but probably best to get some advice. I feel like I'm prattling on actually. And the second question, which should be a little bit easier to answer, is should they sell their current home? And this is a good question, right? This is always a good question to ask when you do a home upgrade. What do you do with the existing property? And I should say quite often people are emotionally attached to it. So they tell themselves it's going to be a great investment, but it's not always the case. It's not always going to be a great investment. So you got to think about, the amount of equity that's trapped inside that property. In this situation, Sienna estimates it's about $500,000. So there's an opportunity cost there. You can reduce your home loan by $500,000. It'll save you 6% each year, every single year compounding. That's a guaranteed return. That's an after-tax guaranteed return versus what are you going to get from hanging on to the property. So it's really just about forming a view on future expected returns. So it's really about asking, if that property is worth $1.5 million today, it's in Bentley, will it be worth $3 million in 10 years' time? What are similar properties been doing in terms of historic growth rates? I mean, that area has tended over the last 30 years to have pretty strong growth, but, it doesn't mean every single property in that location grows at that level. So it's about forming a view on, what the future growth might be. The other thing too is a common observation is, I used to own this property at whatever Smith Street or whatever. I wish I never sold it because now it's worth X today. The reality is that property tends to drift higher over time. And, in a normal market, I mean, it has been a normal market in Melbourne for almost 10 years. But if you look at, say, Sydney or Brisbane, Perth, Adelaide, anyone that's thinking about a property that what it was worth 10 years ago will be able to tell you that same sort of story. So, and then the other thing to consider is how much debt are you left with? I think it's about $500,000. So it's not that big a deal from a non-tax deductible home loan perspective. 35 and 40, so you've still got sort of 20 odd years left runway. You're not in a situation where you're going to have a really high home loan. So that would also, put it into a keep camp rather than a sell. But alternatively, if you think you can do better in a better property or a better market, then of course you got to consider that. I would imagine, unless there's something terribly wrong with that Bentley property, I would imagine you're probably better off keeping it. Just because it's likely Melbourne over the next 10 years will enjoy a growth spurt. You don't have a huge home loan as a result. You've already got a huge amount of cash savings in offset account. So you're in a strong position to, be able to hold on to that asset. And it's likely in a rising tide, all ships rise. It's likely, even if that Bentley property isn't perfect, over the next 10 years, it's likely to enjoy pretty significant growth. So Sienna and Lockie, good luck with it. I'm sorry I couldn't give you a definitive answer on the mum property situation, but it is a pretty complex area and it's becoming more and more complex. In fact, I've got it on my list to write a blog and do an episode about helping parents because, we always talk about helping kids, like parents helping kids, but more and more these days, kids are helping parents. So that's on my list. It might be useful for me to get onto that one. Okay, gone well over time today. Apologies for that. Tomorrow, I'm going to talk about the hidden incentives behind advice. I think many years ago, advisors used to be paid by commission. That was an obvious conflict of interest, but there's still incentives behind advice today, whether it's property advice or financial advice. And that's what I want to talk about tomorrow. So until then, bye for now. Now, before you go, one last thing. My new book is called Wealth by Design. It's not a reprint of Investopoly. It's a complete and absolute rewrite based on what I've refined over the last 8 years. If you'd like to be notified the day pre-orders open and receive my pre-order bonus, register your email right now at investopoly.com.au/book. The bonus is a Investopoly research assistant. That's an AI tool that's trained on more than 500 of my blogs that I've written over the past decade. So you can ask it a question and it will take you to the most relevant ideas and framework. And I'll keep feeding it all my future blogs too, so it'll become a tool you can use ongoing. Again, register at investopoly.com.au/book. Thanks for listening. I appreciate your time.